The hawks and the doves have both really hardened their positions since the last meeting. There are risks on both sides. From the tariffs, there are risks of inflation staying high. You know, it's already been 3% for the last few months, and it hasn't been at its target for nearly 4 years now. So that is why the hawks are quite concerned. On the other hand, the doves are concerned that the U.S. labor market was really softening quite substantially the last few payrolls prints before the government shutdown, and nothing that they've seen since then has allayed those fears. My own leaning would be to protect the labor market because the risks there, I think, are the more urgent risks. But I think reasonable people can disagree, and I think you could expect to see dissents either way the committee goes.
Okay, that's very interesting. And I really want to pick up on what you're saying about the inflationary picture here, because while we haven't seen a massive surge in inflation because of the tariff policy, we've nonetheless still seen inflation remain at fairly elevated levels. How much of that do you think is due to the tariffs, Lael?
Well, inflation was coming back down at the end of last year, pre the tariffs. And I think it was reasonable to assume that inflation would have been around 2.5% or between 2 and 2.5% by now without the tariffs. Instead, what we've seen is inflation round tripping and going back up closer to 3%. And again, I don't think you would worry about that under normal circumstances. But because inflation has been well above 2% now for nearly 4 years, it's reasonable to be concerned that consumers and businesses' inflation expectations could start to creep up, which would make it harder to get inflation back down to that 2% target.
And as you said earlier, you know, the flip side of all of that is, of course, the softening that we've seen in the private numbers coming out of the jobs market. And certainly a lot of it seems to be recently coming out of tech companies, AI related, in other words, AI and automation taking over the jobs of human beings. So you say that probably that's the most urgent priority of the Fed. And yet my question is cutting rates actually going to be able to mitigate that job loss that we're seeing because of AI?
Well, you're asking, I think, the right question. And of course, the Fed is looking at an economy that is in the middle of a big transformation. I do think that is part of the conundrum here. There's really a booming AI sector and everything that goes along with that, whether it be advanced semiconductors, cloud computing, electricity. All of those sectors are pulled pulled along by a very ebullient AI sector, which is also, of course, fueling the strong stock market in the U.S. And then there's the rest of the economy. The rest of the economy is really stuck. It's being hit by tariffs. It has to compete for capital that's really very interested in AI right now. And a lot of those businesses don't know whether they should be planning for a future where their workforces are smaller because of AI. And so there is a bigger challenge that the Federal Reserve is confronting here with the two economies in the U.S.
Yeah, with the two economies in the U.S., I think that's really the perfect way to put it. But do you think, in a way, that the Fed is viewing this whole AI theme and all these investments into AI sort of working as a form of QE, in a way, bringing all this liquidity from the private sector and public sector and leading to potentially a wealth creation effect?
Well, we can see it in the high-end consumers. The top 10% of consumers in the U.S. are fueling maybe 50% of spending growth right now. Of course, spending has remained resilient. And why? It's because they are seeing their stock portfolios going up, their home prices going up. So those Americans that do have equity wealth home ownership, they are seeing benefits from this boom, but the lower 75% of the income distribution instead are seeing higher prices, and they're very concerned. You can see it in the consumer sentiment surveys. They're very concerned about their job prospects going forward. And so there too, you have two different groups that are viewing the economy very differently in the U.S.
If the 75% of the population is feeling that nervousness really regarding their job security and the labor market is showing some cracks, do you think the Fed is now behind the curve then? And also it really makes, perhaps Treasury Secretary Scott Bessent makes a valid point that the Fed needs a chair that is more forward-looking.
Look, the Federal Reserve, every single member on that committee is always forward-looking because they know that their tool, interest rates that they set, operate with a lag. So they are always projecting inflation and unemployment into the future. And I don't think they're behind the curve. I think they are genuinely struggling with two risks that are the natural outcome of tariffs. We knew that tariffs would be a stagflationary shock. That means they push prices higher while they also dampen hiring and economic activity. That's exactly what we're seeing. And so it puts any central bank in a bit of a conundrum. I think the Federal Reserve, starting in August, started to really emphasize cushioning the downside risk to the labor market. I do think that's appropriate. And now what we're seeing is that some members of the committee, and it's almost a half of the committee, is saying, hold on, we don't want to cut too much because of the inflationary pressures, because financial conditions are very easy. But I do think that the chair and the preponderance of members of the Federal Reserve are now more focused on the labor market.